I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, 3 nations in debt, a crisis and the aftermath. First, Dubai, where it's either a bounce back or just a desert mirage. The Emirates going on another building spree. Then Greece, more bailout money's been approved, lifeline or just another sticking plaster. And the default that just won't go away, Argentina's back in the courts trying to escape the clutches of the vulture funds. So we're all about debt this week, and we're starting in Dubai, a city and a topic we're very familiar with, having broadcast from there several times. It's got its major international sporting events, the opening of the world's tallest building, hugely successful aviation shows. No doubt it has done well. But think about the lows too, a debt crisis 3 years ago which shattered the illusions of many about the Dubai dream. And as you'll see this week, it hasn't gone away, because Dubai is still intent on being the biggest and the boldest, even if it could cost $50 billion or about half the Emirates' gross domestic product. This is a new city within a city which was just announced. 100 hotels, mega theme parks, the world's biggest shopping mall, because already having the world's biggest shopping mall wasn't enough, apparently. Massive park area, 30% bigger than London's Hyde Park. All up, it'll be called Mohammed bin Rashid City, named after the ruler of Dubai, who said at its announcement, "The future does not wait for those who are hesitant. We do not anticipate the future, we build it." Which is fair enough, but where's the money coming from? And where's the caution? After going so close to the financial brink, isn't mass expansion just a little risky? Think about this. The situation post-debt crisis, property prices slumped about 60% as retail and office space, homes and apartments all went unsold. More than $700 billion worth of projects ground to a halt. And at one point, it was thought to have owed all up $115 billion. So Dubai will be our starting point this week, but our theme, as I said before, is debt, countries with ongoing problems. Later we'll look at Argentina, where debt dramas in the courts could force the country into default again. And also Greece, where the IMF's agreed to more bailout money, but, is it making any long-term difference? Here's Dubai, though, Hazem Seeker, with a look at how the emirate got itself into trouble and its plans to get itself out.
It's already home to the world's tallest building, the world's largest man-made islands, the world's richest horse race, and the world's biggest shopping mall, to name just a few. But not content with setting world records, Dubai is already looking to break one of its own. New plans are afoot to build the world's biggest mall again. It's all part of an ambitious tourism and retail development project in this city where success is all about excess. But is it too much too soon? Just 3 years ago, the global financial crisis left Dubai almost defaulting on its debt. Property prices and rents crashed as finance dried up. Countless building projects in this rapidly growing desert city ground to a halt. While big institutions have been willing to loan money to the large government-backed enterprises, the small investor has been left high and dry.
He has not returned our payments. There is no money in the escrow account, and he wants buyers to pay more money to complete the towers. The towers have stood vacant with little or no development for several years.
George Shaheen is one of many who bought into the Dubai dream more than 5 years ago. His experience stands as a cautionary tale to future investors.
I would say do not trust these promises. It looks to me like these promises are just made to bring in investor money, that the promises will be broken.
Dubai's made a steady recovery over the last 3 years, thanks to a growth in tourism and a newfound status as a regional safe haven in this volatile Arab Spring. All this might point to the need for a more cautious approach from its rulers this time around. For a city built on glitz and bravado, it appears Dubai is in no mood to lose any of its old swagger.
So let's go to Dubai and talk to someone who's well versed in all of this, Cassandra Hiab, who is the Director of Middle East and North Africa Research at the investment company Exotics. Now, Cassandra, we have covered Dubai a lot on this program. We've been there, we've talked to the people there, done the show from there, and on the face of it, I find it quite hard to believe that after such a messy debt problem 3 years ago, and all the lost confidence and all the restructuring, that this attitude of spend, spend, spend on big projects is still there. Is caution just not in the mindset?
Kamal, caution is definitely warranted. I completely agree with you. And it was quite a shock to see such a big announcement for such a mega project that's going to cost billions of dollars to be announced so soon while Dubai is still in its healing stages. That said, this emirate is known for being incredibly ambitious, and the leader is very visionary. He believes that when you build it, people will come. And if you look at the ruler's track record over the last 15 years, he's created really the shining star of the Middle East, and an economy that's been that was previously 50% dependent on oil to now an economy that's now less than 1% dependent on oil, and majorly dependent on tourism, logistics, manufacturing, and trade flows. So it is definitely, there are many points of concerns that I have with this ambitious project, but it's nothing new for the emirate as well.
Yeah, I think you missed one thing actually off that dependency list there, and that's credit. I mean, it survives on it really. Actually, let me read you this, this quote. It's from a banker who wanted to stay anonymous. He said, quote, "When we speak to the government, they say there is no rush and it shows everything's under control. However, as a banker, I'm worried as I don't know where the money is coming from." And, you know, that's a fair point. It's all about banks and financial institutions who are willing to loan money to Dubai and to finance these projects. Where does the real cash come from, though?
Yeah, Kamal, that's a very important question. It's really the primary concern for this project. Mohammed bin Rashid City and the different projects that have been announced, the 100-odd hotels, the theme park, are going to cost in the range of $20 to $50 billion. This emirate, as I mentioned earlier, is still in its healing stage of the recovery. It's not fully recovered yet. And in terms of financing, we've got the UAE's banks, which still have a lot of bad loans on their books, and now have new restrictions from the UAE Central Bank about how much they can loan to their government-related entities. We've got European banks retracting, and we've got Asian banks that have a very bad taste in their mouth from the different real estate projects they financed and crashed during the 2008-2009 bust. So financing is going to be very tricky, and I think the Emirates going to have to be very creative with the way they finance these projects. More so, it's going to have to be public-private partnerships where the government farms out ownership stakes in these different projects to international operators, hotel operators, theme park operators, to give them an ownership stake in these projects and to help them run it. So it's co-owned, and then they could borrow based on the stronger borrowers' debt capacity. That's one thing. It's also going to have to be funded by private equity, and I think it's going to have to involve other governments in the GCC as well.
Yeah, but what about repayments as well? Because, you know, you've got, as you've just said there, the new things to finance, like this new city. But Dubai has got to think about the past as well and sorting out all those repayments, restructured payments for the previous debt. Is Dubai in a position to do all that, to meet its previous commitments on top of the new stuff?
Well, in the near term, I mean, Dubai has proven itself over the last 2-3 years since the crisis to be able to repay its debt on time and in full, but that only goes for the public debts, all the bank debt. So when I say public debt, I mean bonds and sukuk, but all the private bank loans, especially from the European and Asian banks, for instance, have been restructured, and a lot of these banks have bad taste in their mouths, and that's why they're not as willing to lend into the Emirates or the region. But when we look forward, this year, 2012, had 3 very risky maturities: DIFC, Dubai Holding, and also JAFSA. These were all repaid in full and on time by the government with government assistance. The rest of the debt has also been repaid. Next year is also looking like it's not going to be challenging. 2013 has about $10 billion worth of debt coming due. But when we move into 2016, that's when it starts getting concerning, because that's when the first tranche of the Dubai World loan comes due, about $4.5 billion of the $14.4 billion that was restructured during the crisis. And that's the year when a lot of other restructured loans comes due. And I think it's going to be very challenging for the Emirate to meet these maturities. This bank debt, for instance, on Dubai World is trading 50 cents on the dollar, which implies that the market doesn't believe that it will be repaid, and it will have to be restructured again. So to answer your question, I think the Emirate will continue to honor public debt obligations, but when it comes to a lot of these restructured loans from these questionable entities that aren't financially very solvent, I think a lot of these are going to have to be pushed out again and again until the Emirate can eventually pay them off.
Cassandra, you said the ruler of Dubai had this theory, and it's the old Kevin Costner movie, Field of Dreams, isn't it? If you build it, they will come. Now, that's great. A lot's been built already, and people have come. Tell me your honest thoughts, though, on demand. If you're going to build mega cities, all these new hotels and theme parks and you name it, is there really, really the demand for it all?
I mean, this entire project is contingent on a continued increase in tourism flows. We're seeing tourism increase at 13% rate a year the last couple of years, and we've seen 60 million people go through Dubai International Airport this year. The government believes that by 2019 we'll be seeing roughly 90 million people going through DXB. So there is a huge influx of tourism now, but the question is, will tourism remain? And that is the most important contingent factor for this overall development. If there is more regional instability, if there is problems with Iran and tensions between Iran and Israel heat up, for example, that could really create problems for tourists coming into the Emirates and for this entire project. So I think they're going to try to build this in a measured fashion. I hope they do, and I think that the most important thing is they have to test the waters with different projects first, generate the demand, and then build the different hospitality capacity around that. That would be the smartest way to do it.
Because the thing is, Gaston, there's been a whole lot of people who've been burnt by this, haven't they? We're asking now if there's more demand. You've got to take it back to the time when everything actually slowed up and properties went unfinished, and you had all these people who bought their apartments or their houses or whatever, and they were never even finished. And that's all still up in the air as well. There is still so much to resolve from the past before Dubai moves forward.
Kamal, that's one of the major issues that's why I said that the Emirate is still semi-healed. I mean, we still have 2 islands that are unoccupied and undeveloped. We've got, the Palm Jabal Ali, which is a huge island built beside Jabal Ali, that's still completely unoccupied and unfinished. And same with the World. I mean, there's only a few islands that have been purchased on the World, and it's pretty much completely uninhabited. And so you're building all these colossal new projects. That's why it's hard to swallow to see how the Emirate can continue to build such mega projects at this rate. It's going to have to be, as I mentioned, built out at a very measured pace.
Cassandra Hiab, your thoughts, your insights have been brilliant. Thank you so much for your time today.
Kamal, thank you for having me on the show.
Right, Greece now, and another sticking plaster courtesy of the International Monetary Fund and the Eurozone, though a fairly pricey sticking plaster it is at some 44 billion euros. The thing with this latest tranche of bailout money is that Athens only gets it if it can buy back some debt from some private investors. And really, what chance of that when, without any strong growth, Greece's debt will hit 220% of GDP? And at some point, the Eurozone and the European Central Bank will need to take a loss on the 127 billion euros they've lent Greece so far. In fact, Eurozone nations may need to write off as much as 50 billion euros in 2016 alone. How's all that going down in Greece? John Soropoulos has more.
For these municipal workers, nothing has changed. They don't think any of the money will trickle down to them. All they see is more hardship. Greece will get $45 billion in a fortnight, the rest early next year. About half the money will recapitalise banks. The rest will pay salaries, pensions and state suppliers, including multinational pharmaceuticals. The Conservative-led coalition hopes this will pump money back into the real economy. Some here see it as a dose of interest-bearing poison. Others as a landmark agreement.
There is a positive reaction, definitely. And I think the most important part out of this deal and decision is the fact that the uncertainty with respect to a GR exit is almost zero right now.
It's a small relief because there was no final restructuring of the debt, which isn't fair, because the Germans have already received a lot of money without having given anything, and this is not fair.
Greece's real debt pile hasn't been reduced. The deal was struck after creditors extended the repayment period on bailout loans by 15 years and reduced interest by a percentage point. The radical left-wing opposition, now leading the government in polls, says Greece has become a pawn.
The negotiations and the discussions took place between Ms Merkel and Ms Lagarde, and the compromise was made between them. The solution does not include Greece. It does not include a viable plan for Greece. That is why it is not a solution.
Things will get worse for Greece and for this government before they get better. Next year is forecast to bring deeper recession and unemployment as austerity measures begin to bite on January 1st. So this money will bring only temporary relief. To secure its position in power, the Conservative-led coalition has to bring investments, growth and hope.
Which are three things Argentina did have. But these days, the government there is facing the same kind of backlash. And it's not confined to the streets, it's gone to court too. See, Argentina faced the real threat of defaulting on its debt, and the so-called vulture funds were circling. And it looked like they were winning too when a US judge ordered Argentina to pay $1.3 billion to them. But this week, a dramatic turnaround, and much to Argentina's relief, the Court of Appeal has overruled, but only until the end of February.
The problem facing the Republic of Argentina today is judicial colonialism on the issue of sovereign debt. The same applies for developing countries facing a similar crisis, or perhaps even more serious than the sovereign debt issue we're up against.
But where's all this come from? And here's an idea, how's a ship stuck in an African port involved too? Teresa Bo in Buenos Aires has the background to this case and further reaction in Argentina.
The Argentine vessel Liberata remains detained in the port in Ghana. The order to hold the vessel was issued by a local court in favor of an investment fund that specializes in suing over unpaid sovereign debts. Argentines are trying to gather 1 million signatures to free the ship.
The vessel is not only a historical boat, but is also part of our assets. It has taken a message of peace wherever it has gone, and we want to show that there are 1 million Argentines worried about its future.
The vessel symbolizes the economic stakes involved for Argentina in the latest twist of a legal battle over $100 billion of debt the country defaulted back in 2001. While it was suffering from an economic crisis. In 2005 and 2010, the government restructured the debt, offering its creditors about 30 cents on every dollar. It ended up settling 93% of the claims against it. But a handful of bondholders, referred by the government as vulture funds, did not settle and have continued to seek legal means to acquire their payments in full. Since 2004, the so-called vulture funds have tried to seize 28 of the nation's assets, including state-owned property abroad, artwork, and the presidential plane. The Argentine government so far has won all these cases in lengthy judicial processes in foreign courts. But Argentina's luck changed when a US judge ordered the government to pay $1.3 billion and threatened to hold payment to the vast majority of Argentines' current bondholders. A remedy that put Argentina on the risk of technical default once again. But on Wednesday, a US appeal court suspended that ruling for 3 months.
The judge's decision was personal and political because it does not consider international law or the consequences for the financial market. After the suspension by a US court, Argentina will pay those that we agreed to pay initially, and we will see what we propose in the vulture funds.
That's good news for the bondholders who sided with the government and have argued they shouldn't be punished for the hedge funds that did not settle. For the government, it's a matter of sovereignty. For now, it's a short victory for Argentina, but the legal battle is far from over.
With us now to explain more of the ins and outs of this is Hawa Qureshi QC. He's an expert in international arbitration at McNair Chambers in London. Hawa, how would you describe Argentina's position right now, given it's got the stay of execution but isn't in the clear yet?
The situation dates back, of course, to the moratorium in December 2001 when about $80 billion worth of debt was effectively unpaid. We track forwards to June 2010. Argentina was able to negotiate with 93% of the bondholders to accept about a third of what the face value of the bonds was. 7%, the holdouts, have managed to persuade the Court of Appeal in New York that they're entitled to payment out, and the condition that's just been stayed was the payment of $1.3 billion by 15th of December. The Court of Appeal is going to hear the appeal on the 27th of February. The general consensus is that it's unlikely that the Court of Appeal, even though it's going to be the full bench, is going to overturn the substantive finding as to the fact that the holdouts, as they're called, are going to have to be paid at full on the face value.
Okay, you've pointed out at the start of there how far back this goes, a long-standing debt problem which doesn't disappear easily. And on this program, we've looked at other places too, Greece and Dubai, and the theme, seems to be that debt issues don't go away. They just get restructured or transferred and changed. In this case, in Argentina's case, they get sent to court.
But there are multiple reasons why. First, regimes come and go. Second, you're dealing with a very large group of creditors. Trying to obtain consensus amongst such a large group is extremely difficult. And where you have the bondholder population as expansive as it was, the issue that's arisen is because 7% fronted by or spearheaded by NML Capital have maintained that they're entitled to payment out at the full face value, they having bought into those debts in the latter years after the default, many of them after the default took place. But you're right, there's a similar problem in Greece, and there seems to be an inability to be able to grapple with the question once and for all. But that's primarily, as I say, because of the nature of the creditor population and the fact that states are facing currency crises, credit crises all over the world at the moment.
Yeah, and with all that, the confidence disappears. You know, I'm reading here, Fitch, the ratings agency, has downgraded Argentina to one step above default because it thinks the government won't pay. It's a knock-on effect, and it must just kill confidence in the place in Argentina.
It's a great pity because, of course, Argentina has been one of the success stories of recent years so far as Latin America is concerned. But we've got to take this within context. The likelihood is that there is bound to be more scope for negotiation, and we have to wait and see what happens between now and the 27th of February. So far as Argentina is concerned, we've seen negotiation at the 11th, at the 13th hour with Greece, and one assumes that similar processes are already at play so far as Argentina is concerned.
That is Khawar Qureshi QC filling us in on Argentina's ongoing debt problems and its day in court as well. Khawar, thank you for your time. And finally this week, the Philippines. We've talked a lot about how Asia has fared better in this global economic crisis, particularly the Philippines, where growth figures have exceeded expectations, investor confidence is high, and the currency is getting stronger at a record speed. Do all these positive signs mean equally good times for all Filipinos, though? Margaret Ortigas tells us more.
This is the first time Joanne and Rolando Agumbay have been home in 2 years. They left Manila to work in the Middle East to give their family here a better life. Now they see firsthand that the money they send home every month no longer goes as far as it used to.
It's worth almost 10% less. For every 1,000 reals we'd send, you could get 11,000 pesos. Now that's down to 10,000. We've little other choice than to take on second jobs just to be able to make up the difference in what we send home.
There are now over 10 million Filipinos working abroad. They're considered national heroes. The money they send home helps keep the Philippine economy afloat, along with the influx of international call centers, expanding exports, and a tourism boom. But success has created an unusual problem for the Philippines, a strong local currency.
10 years ago, an average of $1 to 200 million US was being traded here on a daily basis. That figure is now closer to $1 billion US. The central bank has been seen to be buying dollars in the currency market to temper the Philippine peso's appreciation.
This year, overseas Filipino workers are expected to have sent home some $24 billion US by this Christmas. That will probably make the peso even stronger, a double-edged sword as far as many here are concerned.
The structure is such that of the economy was that the services sector is the one really pushing us up. But with the appreciation of the peso, there's a lot of adjustments that need to be made.
Regional economists agree that the progress the Philippines has made recently has been long overdue. The country was known as the laggard of Asia for decades. So whatever adjustments it will need to make now are a small price to pay for finally losing that title.
And that is where we'll leave you for this week. Here's how to get in touch, though. 3 easy ways to do it. 2 of them are Twitter. At KamalAJE is my name on Twitter, and at Abid Oliver Ali is our business editor. There's also our email address, countingthecost@aljazeera.net. Then you can head to aljazeera.com/business. Link on to our page there to find all our episodes in full for you to catch up on whenever you would like. That's it, though, for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.